2025 has been an absolutely crazy year in the stock market, and yet the S&P 500 is only down 4.5%. And despite massive fear from all the tariff uncertainty, the market is actually up 12.3% from that April low. And just over the past week, we're up 2%. It's nearly impossible to time the exact bottom of any stock market correction or crash, but there is always opportunity to invest in high-quality businesses that will continue growing well into the future. And this week, we just got a stark reminder of that with the biggest earnings week of 2025. Hundreds of the biggest companies in the world just reported their earnings this week, and many gave guidance for what they expect in the coming quarters. And there were many companies that absolutely crushed it, most notably the best companies in the world, the big tech companies. For example, Microsoft and Meta both beat their earnings estimates by a large amount and reported great growth overall. And frankly, many of these companies are still in incredibly strong positions. And I think that's the reason why the market is holding up so well. However, there were also companies that sold off after earnings to various degrees. For example, Apple, one of the most valuable companies in the world, sold off nearly 3% after earnings. And then you have other popular dividend growth stocks like Aflac as an example that reported pretty poor earnings and sold off quite a bit. So today I'm going to share some of the earnings winners and losers from this week, and that will include many top stocks that I am currently invested in, including companies I have been buying over the past month. And before I jump into that analysis, I want to thank our sponsor Earnings Hub, which is the official source of earnings news for Dividend Data and dividenddata.com. You can try it out for free with the link in the description. And with that said, let's roll the intro and jump into this week's earnings winners and losers. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using my research tool over on dividenddata.com, which is the best source to do fundamental stock analysis. And by the way, we have this great AI analyst over on dividenddata.com where you can get summaries of the latest earnings calls as they happen. And it's only because of this AI tool that I've been able to keep up with all the earnings news on my stocks, especially in a week like this. For stock number one, I'm going to talk about Microsoft, ticker symbol MSFT. They beat analyst estimates on earnings per share by 7.45% and beat on revenue 2.41% year over year and beat on revenue by 2.41%. Following this news, Microsoft stock went up 7.63%. And as you can see, they've continued their long history of earnings growth. If you want to know more about my thoughts on Microsoft earnings, then please check out the video I just put out yesterday. I go into depth for 10 minutes just on Microsoft's business and their earnings. So if you want to know more, please go watch that video. And if we go and look at my personal dividend growth stock portfolio, Microsoft is one of my top holdings. It's currently at number 2. I just added to it a little bit over this past month, and I have a 66% total return. So based on the actual results, which I went over and analyzed in that video, and the market reaction to the news, Microsoft should definitely be in the winner category this week. So let's give an example of a loser. Earlier this week, Aflac stock, ticker symbol AFL, reported earnings, and they missed on results and then ended up selling off nearly 5%. And if we look at these results, they're surprisingly bad. They missed revenue expectations by 20.42% and earnings per share expectations by 1.19%. And if we look at Aflac stock over the longer term, you can see that it's been a great performer in the stock market with growing earnings and stock price appreciation. Plus, this is a dividend growth stock with a 2.24% dividend yield and a sustainable payout ratio based on both free cash flow and earnings per share. The company's dividend is growing at a 5-year compound annual growth rate of over 15%, and they just recently announced a 16% dividend increase. So let's take a quick look about what went wrong in the earnings and why the stock was selling off. So I'll head over to the AI analyst on Dividend Data and say, summarize the latest quarter and earnings call for AFL. So this is coming from real transcripts from the earnings call. And as we can see, revenues were down big time year over year, $5.4 billion to $3.4 billion. So we're going to want to dive in what exactly happened there. We also had earnings based on GAAP accounting really low at $29 million compared to $1.9 billion the year prior. However, with adjusted earnings per share, which I think is what Earnings Hub was using previously, that is down 5.7% year over year. Aflac is an insurance company, so they invest a lot of the float they have, and according to this, they experienced $963 million in net investment losses this quarter. And in the year prior, they had a $951 million investment gain. However, it's important to mention that these are just on paper investment losses, and they are calculated in GAAP accounting. And if we look at the adjusted earnings for Aflac, which is really the cash coming in, you can see that was a pretty standard quarter. And the company actually has been buying back stock, so their adjusted earnings per share remained unchanged at $1.66 in the quarter. And you can see that even here on dividenddata.com, you can see the latest quarter, $1.66, and the year prior, $1.66. And as I mentioned, the company is buying back a lot of stock over time. You can see the rapid reduction in shares outstanding every single year. In fact, just this past year, it went down 5.63%. So I'm not personally an expert on the insurance business, and I haven't dived deep into Aflac's business, but I would not be overly concerned about the long term here with Aflac stock. But the earnings miss and the sell-off would put it in the loser category for this week. And over the long term, Aflac stock has been a great investment. Since 1990, the company has had a total return with dividends reinvested of 16,366%. And Aflac will likely continue to be a high-quality dividend growth stock well into the future. Now let's get to another stock in the winner category. We have Meta Platforms, ticker symbol META. This is the big tech company owned by Mark Zuckerberg. That's the parent company of Facebook and Instagram. And they've been absolutely crushing it. They beat analyst expectations on earnings per share by 21.78% and beat on revenue by 2.26%. And as you can see, that sent the stock price up 4.23%. Meta is a company that has been on my radar, and I am considering adding this to my long-term dividend growth stock portfolio. They are a new dividend payer, and they just had their first dividend increase, albeit it is a small dividend with a 0.37% starting dividend yield. I actually do think they still trade at a very attractive valuation given their high growth rates with earnings. And as I will soon break down, they're expected to continue high growth in the future. And if I had this more on my radar, this was a no-brainer stock to buy in that 2022 tech sell-off, and really through most of 2023 as well. If you're analyzing Meta's business, they are primarily a digital advertising company, so they have these huge social networks with high engagement and network effects that keep those platforms engaged and growing. And then they monetize that attention through digital ads on their platforms. And this is increasingly becoming one of the best advertising platforms you can use. Meta is also a leader in artificial intelligence, and one of the key use cases they're seeing for it is using AI to improve their advertising business, both in matching the content to interested users and improving conversion through the back end. And you can see they're already seeing internal results from this in their business. Meta's revenue per share has grown at a 30% 10-year compound annual growth rate. That's insane. This has slowed down to a 3-year CAGR of 15%, which is still great. And in a similar manner, free cash flow per share was 31% 10-year CAGR and 15% 3-year CAGR. You really just have to be amazed with how great of businesses these big tech companies are. They are cash flow machines, and they have great balance sheets. And if we dive in the latest quarter, you can see total revenue increased 16% year over year. They also gave their engagement numbers, which is just crazy. Across Meta's apps, they have 3.4 billion people that use at least one of them daily. And similar to a lot of the big tech companies, Meta is investing a lot in AI infrastructure. That's to train their own models, which they use in their products, and they have their open source Llama model. But overall, everything's looking good at Meta. The future outlook for Q2 2025, they said they expect total revenue to be between $42.5 billion and $45.5 billion, which signals continued growth. They also gave context for full year 2025 expenses, which takes into account their AI spend. They're projecting that to be between $113 billion and $118 billion. And you can see here the expenses for this Q1 were up 9% year over year. So they are spending more money, but they also saw total revenue grow 16%. So Meta is definitely in the winner category. And since going public in 2012, they have a 1,400% total return. It's a 23.3% compound annual growth rate. And let's actually do another winner right now. Let's do the Altria Group, ticker symbol MO. This is the third largest stock in my dividend growth stock portfolio. I have a 66% total return on this one as well. And it is my largest dividend payer, paying me $2,280 a year. And I am excited about this one because they just paid me a $570 dividend. They reported earnings this week. They beat on EPS estimates by 4.24% and revenue estimates by 14%. That was a very big revenue beat. And overall, Altria stock has been on the rise over the past year. and this has lowered the dividend yield now to 6.88%. I was buying the stock in the 9 to even 10% dividend yield range. And this is a slower growth company, but you can see that their earnings per share are still going up. And if we summarize the latest quarter and earnings call for Altria Group stock, ticker symbol MO, their revenue, despite beating analyst expectations, was actually down 5.7% year over year. Adjusted earnings per share was up 6% year over year to $1.23. And just as an example, if we go back to the EPS chart on dividenddata.com, you can see $1.23 in March 2025 and $1.15 in March 2024. And the other most important part of this quarter is that they reaffirmed their 2025 earnings per share guidance of $5.30 to $5.45. If you're wondering why the GAAP net income earnings per share was down, that's because they had an $873 million non-cash impairment charge in the quarter. This is something Altria has occasionally had from bad investments in the past. This specific one was due to eVapor reporting unit goodwill. But overall, Altria looks poised for continued strong, slow growth from this base, and I would expect mid-single-digit dividend growth in the future, which is not bad for a stock that yields nearly 7%. And as someone who bought this at a 9 to 10% yield, it's even better. So not a very newsworthy quarter for Altria, but I'll put it in the winner category. And this stock just reported, and I guess we'll put it in the loser category. I don't want to be mean, though, because it did pretty well, but Apple, ticker symbol AAPL, they sold off 3% after reporting, and the initial look of the prior quarter was good. They beat earnings per share by 1.23% and beat revenue expectations by 0.88%. And as we take a big picture look at Apple, they're continuing to grow earnings per share over the long term, albeit real growth overall has been pretty slow for a number of years at Apple. Their earnings per share number is basically juiced by their large share repurchases. They're reducing their shares outstanding by about 3% a year. And I'll briefly go over the results from this quarter, and they were pretty good. But the real story with Apple is what's going to happen in the coming quarters. So notice that I added in my prompt, what is the outlook? And also, what did they say about tariffs? Tariffs is a big storyline with Apple stock since they manufacture a lot of their product portfolio in China. So I'll dive into that. But Q2, things were good. Revenue was up 5% year over year. EPS was up 8% year over year. Services revenue, which is the big growth category for Apple stock, is up 12% year over year. iPhone revenue is up 2%, Mac revenue is up 7%, and iPad revenue is up 15%. And given that services is their big growth business, their install base of users on Apple products is a very important number, and they just hit all-time highs across all product categories. And because of these good results, the board just declared a 4% dividend increase, which is in line with what they've been doing recently. And they also authorized an additional $100 billion share repurchase program. As you can see, Apple pays a dividend that slowly grows, but it's very small relative to the amount they allocate towards share repurchases. But let's get to the real news with Apple earnings. For the upcoming June quarter, they're expecting revenue growth in the low to mid single digits. They're expecting gross margin to be down to 55.5 to 56.5%, and that is due to $900 million in tariff-related cost. And it should be noted that they are still getting exemptions from the very high tariffs, and there's definitely a lot of uncertainty around their Chinese manufacturing, and they're probably going to have to move that to other countries like India as an example. So yeah, for this coming quarter, Apple's expecting $900 million of cost from tariffs. And that's probably just the start, to be honest. And despite Apple having this growing services business, hardware is their main revenue source at this time, specifically in the iPhone. That's over half of their business. And the majority of iPhones is manufactured in China, which is a huge hit from this tariff war. But on the earnings call, they gave some additional clarity, which I actually didn't know. The majority of iPhones that are sold in the US, so they would be tariffed, actually originate from India. Now, it's not all, but the majority. Now, as of right now, I'm pretty sure there's still the 10% baseline tariff on products from India. And this is all going to change as well. We're going to get a lot of trade deals probably over the next few months. Also, almost all iPad, Mac, Apple Watch, and AirPod products that are sold in the US actually originate from Vietnam. China is still a huge manufacturer, though, for Apple, but it's mostly to product sales outside of the US. And Apple has really been diversifying that supply chain to these other countries, really since Trump's first term in office. But still, this is not good for Apple. A lot of iPhones sold in the US are still manufactured in China. And they've been exempt from this crazy 125 or 145% tariff, but they still have to pay this 20% tariff on US imports. And really, it's not known whether that's going to go up because it was a temporary exemption. Tim Cook mentioned on the call that he's refraining from predicting future impacts beyond the June quarter. So Apple stock has sold off about 3%, and that seems pretty reasonable. And because of all this tariff uncertainty with the stock and also kind of the lower growth rates I've been seeing in recent years, I'm going to put it in the loser category. Although Apple is still one of the best businesses in the world, they are a great company and they will be around for decades to come. Another very popular company that reported earnings this week was Starbucks, ticker symbol SBUX. And the results were not that great. They missed earnings per share expectations by 18% and revenue expectations by 0.99%. And Starbucks stock sold off nearly 10% after the news, but it regained some of that, going up 6% the following day. But they're still down over 3% since reporting earnings. As we take a look at Starbucks stock, you can see that 41-cent earnings per share is a big drop. And really, this is the worst performance we've seen since the pandemic. Historically, though, Starbucks has been a strong dividend growth stock, with the dividend growing at a 14.3% 10-year compound annual growth rate. However, this has slowed to a 3-year CAGR of 7.5%, and their most recent increase was 7%. And if we look at the latest earnings for Starbucks, you can see that GAAP earnings per share was down 50% year over year, and non-GAAP earnings per share was down 40% year over year. And they mentioned that they saw operating margin contractions in the quarter due to various factors, including increased labor costs and promotional activities. Starbucks just got a new CEO, by the way, Brian Niccol. I think he'll do a pretty good job. He was the Chipotle CEO for a while, and he has this new back to Starbucks turnaround strategy. So this is a company going through a turnaround, so you should expect pretty volatile quarters over the coming year. And I wouldn't be surprised if there's more sell-offs like there just was. But if you like the company long-term and think they still have room to grow, then these could be buying opportunities. So you probably have to put Starbucks stock in the loser category for this quarter. But sometimes when a stock sells off, that can create buying opportunities. For example, Starbucks now has a 3% starting dividend yield, which is historically one of the highest dividend yields ever for Starbucks. So if you think they can continue having 7% dividend growth and potentially even go back up to 10 or 14% dividend growth, then this might be a pretty good entry point. And since 1992, Starbucks is actually one of the best performing stocks in the stock market with a 29,800% total return. That's actually insane. However, a lot of that was in the past, and companies can change over time. The 5-year total return for Starbucks stock is only 27%. So if you want to do more research on Starbucks stock, I suggest you use a tool like perhaps dividenddata.com. And there's hundreds of other stocks I could have covered in this video, but the last two that I'm going to discuss are two midstream oil and gas companies that are in my portfolio. That's Hess Midstream LP and Enterprise Product Partners LP. One of these I've had for a number of years and haven't added in a while. That's EPD. The other I just added this past month along with MPLX, and I will be making full stock review videos on each of those companies, and I may even do another full update video on EPD. But I'll definitely be talking about these in my coming portfolio update video in a couple days. So if we take a look at EPD, they did report earnings this week, and earnings per share missed expectations by 12.33%. So that's a pretty big miss. However, they beat revenue estimates by 7.2%. And if we take a look at EPD, you can see this is a company with slow earnings growth over time. Really good starting dividend yield still at 7.16%. Reliable dividend growth sometimes every single quarter. Recently, they've been doing every other quarter. The 5-year compound annual growth rate of the dividends, 3.75%. Net income for the quarter was down 6.6% year over year. So $1.5 billion versus $1.4 billion. Earnings per share is down 3% year over year, 66 cents per share to 64 cents per share. So that's pretty negligible, to be honest. Distributable cash flow, since this is a partnership, all three of those midstream companies I own are limited partnerships, and the dividend is paid out of their cash flow. That was up 5.26% year over year from $1.9 billion to $2 billion. And as I mentioned earlier, they've increased the quarterly distribution from this quarter last year over 3.9%. So really not that crazy of a quarter for EPD. The main news I saw is they're investing in a couple new gas processing plants and a natural gas liquid pipeline. And these are pretty good growth businesses. That's one of the reasons why I've been adding the pipeline stocks. And the company has been allocating more in growth capital. Specifically, $960 million was allocated in Q1 2025. And that's for those natural gas projects. And they gave an expectation that they will be investing $4 to $4.5 billion for the full year. So EPD stock for the week is down 4.42%. And with the earnings miss, I assume we have to put that then in the loser bucket. But again, when I say loser bucket, I mean just for this week, this quarter, this earnings season. And there are often many factors that can impact a stock price outside of earnings as well. For example, with energy stocks, the price of oil and gas is a huge factor. Over the past week, crude oil prices are down 6.9%. and this has sent some energy stocks down during the week. However, what I like about these pipeline stocks is that they are less directly exposed to the price of oil, as they have contracts and agreements based more on the volume and less on the commodity price. And I'm really excited to dive into that in my full stock review videos of these companies. And as an example of that, Hess Midstream LP, ticker symbol HESM, which is another company I bought a lot over the past month and reported earnings this week. They have a lot of contracts that are specifically negotiated around inflation, and many of their contracts are shielded from commodity prices. Just as an example, and again, I'll go into this in more detail later, Hess Midstream has long-term commercial contracts, and it's 100% fee-based contracts that minimize commodity price exposure. No direct commodity price exposure with inflation escalation. So in an environment where I think the price of oil is going to continue to decline, but volumes of oil and gas are probably going to increase, I think these midstream companies are going to be doing well, at least relative to the oil producers. HESM also reported earnings this week. They missed EPS estimates by 5.8% and beat revenue estimates by 0.10%. This is a company with slowly growing earnings per share, a really good dividend yield at 7.74%. They've been seeing stock price appreciation as well. And HESM and MPLX, which I will cover soon, these are dividend growth machines. HESM has a 5-year compound annual growth rate of the dividend of 10.49%. That's a 3-year CAGR of 8.9%. They increase it every single quarter, and they just announced a 1.23% dividend increase. In the quarter, they saw volume increases across gas processing, oil terminaling, and water gathering systems. And in this quarter, they repurchased $100 million of Class B shares and increased its quarterly distribution. They reaffirmed their full year 2025 guidance. They're anticipating volume growth in Q2. And for their distribution or dividend, Hess Midstream is continuing to target at least a 5% annual distribution growth. So 5% is their baseline, and in recent years, they've been going above that. And the company is expecting organic throughput volume growth across its entire company for 2026 and 2027 relative to the 2025 guidance. They're also making some growth investments as well. For full year 2025, that's expected to be around $300 million. And Hess Midstream has been a sneaky high performer over the past 5 years. That's a 5-year total return of 240%. And its valuation is still relatively compelling, and they pay a high yield, high growth dividend. So that's a quick summary of the biggest earnings week of 2025. And I just scratched the surface. There are gigantic companies that are likely in your portfolio that reported this week. So if you want to do your own research, I suggest heading over to Earnings Hub. You can use it for free. And if you want to use the full stock analysis platform I showed throughout, all of that is available at dividenddata.com. The link is in the description and pinned comment of the video. There's a 30-day money-back guarantee, so no risk in trying it out. I'm regularly adding new features and improving the product, so I would really appreciate your support if you head over to dividenddata.com. That is the best way to support the channel and make sure we continue producing high-quality content. With that said, thanks for watching, and I'll see you in the next video.